Greetings, Eddie Ardeni here. Let me straighten out the camera here. There we go. Good. Well, thank you all for joining me this morning. Obviously, lots to talk about, given that the events of the weekend, Russia basically, Putin basically declaring that he has decreed that two Russian enclaves in Ukraine on the eastern border of Ukraine are independent republics. So by decree, he created two independent republics in the Ukraine. And the next step is he's going to simply move his troops in there without presumably much resistance, since there aren't too many people there. And in addition to that, it's not clear that the Ukrainian army really wants to start shooting against the Russians in that area. But clearly, this could be a setup for moving troops into Ukraine itself. Not to say that these two republics aren't the Ukraine, but this may be what Biden was kind of stumbled upon when he said that as long as it's not anything but a minor incursion. Well, I guess from the administration standpoint, and maybe from some other NATO members, so far as a minor incursion into the Ukraine. But sanctions are being implemented, being discussed and implemented for this egregious violation of a sovereign country's borders. So what is this all about? Well, clearly, as we all know, Putin would like to put the Soviet Union back together again. He wants to see Humpty Dumpty back together again. That will be easier said than done, especially if the West stays united, and at least imposes some severe sanctions. Though he's clearly not that concerned about the sanctions that might occur. And in addition, there's potential here for a revival of the Cold War. I think in some ways this does suggest that the Cold War is back on. The other thing that's important here is Putin just doesn't want to put the Soviet Union together. He's also responding to something that happened in 2004 in the Ukraine, and that was, I guess my dogs have decided to come visit. In the Ukraine in 2004, there was a so-called Orange Revolution. I don't know what Putin's favorite color is, but I'm sure that his least favorite color is orange, because the Orange Revolution, with peaceful protests, managed to overthrow the Kremlin's chosen ruler of Ukraine, and they were able to bring in a reformist government. That didn't last that long. By 2010, Putin's people were back in, but by then, the Ukrainians had actually gone through a lot in terms of democracy, getting a taste for it. And this is something that Putin just can't stand. And why did it take him so long? Well, obviously, he's been preparing his military for exactly this kind of action against the Ukraine, and also anticipating how the West might respond to all of this. China's clearly watching to see how this plays out. China obviously would like to take over all of Taiwan, and that could obviously be a really crazy geopolitical scenario where we've got major issues with Russia, major issues with China in a geopolitical way. Where does this impact the economy? Well, with regards to Russia, oil is a key issue. It's not clear that the West is going to respond to all this by unilaterally declaring that we're not going to buy any more Russian oil or Russian gas, though the Nord Stream 2 pipeline has been put on hold by the Germans. So that's some progress and some meaningful sanctions. But again, Putin has these ambitions of going down in history as the fellow who put the Soviet Union back together again. And obviously, that's going to remain a real serious issue for the West, and certainly for financial markets. The offset, perhaps, to the issue of oil coming from Russia is the Iranian deal. It looks as though the Biden administration is pushing to get it done, which would probably mean there's be more oil coming out of Iran. And that's kind of can maybe explain why, after what happened this weekend, we didn't go straight up to $100, but went up by a buck or so to $93, $94. Clearly, if we had an issue with China and Taiwan, that would be a potential disaster in all sorts of ways. And one of the obvious ways is semiconductors. Taiwan is a major exporter of semiconductors. So the geopolitical issues have come to the fore. They're a big deal. Generally speaking, geopolitical issues, unless it leads to World War III, in the past we've had plenty of geopolitical issues that have turned out to be buying opportunities in the stock market. Didn't seem to have any long-term serious economic consequences. One thing that obviously is a consequential potentially is a spike in the price of oil. If in fact this all leads to a significant spike of oil from here, and it's already up significantly, we do know that history shows that oil spikes are associated with recessions. Not the only reason why that happened. For example, 2008, we had a spike in oil to almost $150 a barrel. And yet everybody remembers that what caused the great financial crisis and the recession was in fact the collapse of the housing industry. But clearly $150 oil had to have some impact in the recession that we had back then. So we want to be cognizant of the fact that while there hasn't been much reason to worry about a recession, given that the Fed funds rate is still zero and that M2 is well above its trend prior to the pandemic, we do have to be concerned about the impact of rising oil prices on consumer confidence and, more importantly, consumer purchasing power. If they have to spend more, if consumers have to spend more on oil, that's less available to spend in other areas. I am becoming increasingly concerned about a wage price spiral. The Fed is taking its sweet time here deciding what to do about the Fed funds. I mean, they've clearly decided that they're going to be stop buying bonds, treasury securities, mortgage-backed securities as of March. But they're still kind of coy about whether it's going to be 25 or 50 basis points at the March 15th, 16th meeting. And there's hawks and there's doves, and it's not clear what decision they'll make. But I think they're trying to be data dependent. Remember that. And they are watching out for the next round of inflation indicators. And if they are shockingly bad again, as was the January CPI at 7.5%, they'll probably go for a full 50 basis point increase. And the hawkish talk will continue. It's not clear that how exactly higher interest rates, unless they're the kind that Volcker implemented to cause a recession, short of causing a recession, it's not clear how gradually raising the interest rates or even letting the balance sheet mature and therefore decline somewhat, how that's going to bring down inflation, especially now that we are seeing more and more signs of a wage price spiral. Last fall, Walmart and Amazon announced that they were increasing their minimum wages. And think about that. I mean, the two major employers in our country, major sources of disinflation in the United States, the two major ones, are no longer really bringing in disinflation. I mean, they are, but what's really changed is they're leading the pack in raising their minimum wage, and they obviously are very influential because everybody else has to compete with them in the labor market. We know labor market is extremely tight. And then there was some news that Amazon is going to be raising its base pay for salaried employees. And then you might have seen the Wall Street Journal article this weekend saying that there's a lot of competition for talent, particularly in the financial industry, and their pay is going up. So wages are going up, not just for lower wage workers, but also for higher wage workers. And meanwhile, all the data I'm looking at suggests the margins are holding up remarkably well. at record highs. How could that possibly be happening with all these pressures? And the answer is psychologically, everybody knows that things have changed and that it's okay to raise your price because your costs have gone up. And so you're not really seeing much resistance to these price increases. You saw that the January retail sales were surprisingly strong, even when you take out the inflation component of it. I am concerned somewhat about buy in advance attitudes starting to come in. Inflation is just something we haven't experienced in a very, very long time. This 1970s experience is relevant, but this is not the 1970s. This is the 2020s. And psychology, demographics, fiscal monetary policies, so many differences between now and then. But there is an increasing sense of deja vu all over again. And having geopolitical issues mucking things up on the inflation side is exactly what happened in the 70s when we had two oil shocks created by the OPEC cartel. Well, let's go look at some of the economic charts to see what we addressed in the latest morning briefing. So let me share. Sharing is caring, as they say. And we already saw that when you came in. So let's go to the charts. And here's the chart collection. And most of the morning briefing today is focused on looking at the various pieces of the economic puzzle. How's the economy doing all in all? And obviously, that's especially relevant after the weekend. Can it withstand, can it handle these kind of wage pressures and inflation pressures and oil pressures and so on, geopolitical risk. So here we have the consumer surveys of consumer confidence and the Consumer Sentiment Index. We watch them closely, as everybody does. They don't always tell you the same thing. And as a matter of fact, they've really diverged. We've observed, Debbie and I have observed that the Consumer Confidence Index tends to be very weighted by people's attitude towards the labor market. And so it's not surprising to see that it collapsed during the lockdowns, stayed down for a while, and then it's improved dramatically, and now it's down somewhat. But again, there's other things going on here. It's not as though the Consumer Confidence Index doesn't reflect inflationary psychology, which is more heavily weighted apparently in the Consumer Sentiment Index, which you can see is down quite sharply. So on the one hand, you've got a booming labor market, people feeling awfully good about the ability to just quit your job and find something better, making more pay. But that's kind of on the margin, whereas inflation is something that affects everybody. And so it's not surprising to see this kind of divergence, given what we have observed as the different weighting that these two surveys have. Here's the current conditions. Current conditions look pretty good based on the Consumer Confidence Index, not so good based on the Sentiment Index. And then there's the expectations. And again, we have the same kind of situation where the expectations in the CSI is much more sour than it is for the CCI. We put the two of them together, average the two of them, why not? Call it the Consumer Optimism Index, and it's nothing to write home about. Consumers had been on an optimistic course, but inflation has kind of set them back when you put them all together. Unweighted, they're equally weighted, I should say, in the way we do our averaging. Again, current conditions look pretty good until inflation became much more of a concern, and expectations are kind of depressed. I mean, when you look at it, they're not any better than they were coming out of the pandemic. The good news is consumers do have jobs. Employment has been increasing, and the good news is that as a result of all that, consumers have been getting good pay increases in current dollars, not so much in inflation-adjusted dollars, and yet enough so that retail sales bounce back. But this is kind of looking a little volatile of late. And I think the issue is whether we go back to the trend that we had prior to the pandemic. And there's no particular reason why we wouldn't, especially to the extent that this satisfied a lot of pent-up demand. So it's hard to get really excited about the outlook for consumer spending on goods, with the exception of autos. There clearly has been a shortage of autos. Let's skip that one. We'll skip that one too. That just shows you that the retail sales of food services and drinking places has actually been kind of flattish for a while. Well, it's relevant because if consumers aren't going to spend on goods because they've satisfied a lot of their pent-up demand, with the exception of autos, perhaps, that means that as the pandemic continues to abate, which it seems to be doing very nicely, then there'll be more spending on services. And the services has been held up back in the past few months by the Omicron variant. But meanwhile, consumers have been spending on anything housing related, as you can see here, basically record high. And we just saw Home Depot come out with gangbusters earnings and guidance. And I think that was clearly reflected in this chart. The auto industry is still kind of stumbling, trying to get their production going to higher levels to meet demand because they can't get the semiconductor chips. You might have read that GM is actually putting out cars now. I mean, this is a disaster without heaters in the seats because they can't get the semiconductors for them, or they want to use them for something else, maybe the windshield wipers. I don't know. But industrial production looks okay. We have the consumer goods production is doing pretty well, notwithstanding the weakness in car production. And the business equipment has recovered rather nicely, though this was kind of a flattish trend. I have to excuse myself for a second. Once again, Chloe has come in right during the conference, and I'll let her out. I'm coming back. Sorry about the interruption, but Chloe wanted to go out. So here we go. We've got the industrial production of durable consumer goods. As you can see, we've got a lot of strength in computers, video, and audio and equipment. People staying home, working from home, buying that kind of stuff. Appliances, furniture, carpeting, not so much, which is a little surprising, actually. But then again, we import a lot of this stuff, and imports, as we'll see in a minute, are absolutely booming. Auto production, kind of flattish. Industrial production of business equipment. I'm very encouraged to see that the information processing remains on a solid upward trend. Industrial and other is this one, and there's something called industrial machinery, which is going just straight up. So that suggests that we are seeing some movement by companies to spend more on equipment and technology to deal with the labor shortages. And I think they're also onshoring, which is another source of capital spending. So capital spending still actually looks pretty good to me. It's transit that's kind of going nowhere yet. We just recently, well, I'll show you in a minute. We looked at truck sales, and truck sales are very strong. So real inventories, there's plenty of room for rebuilding manufacturing real inventories, retail real inventories. Wholesaler actually managed to revive their inventory levels. Skip that one. Here's the story on the trucking side of the equation that's relevant to the economy. The ATA truck tonnage index has been kind of going nowhere, but at a high near record level. So you can still see plenty of trucks on the highways. Payroll employment for truck transportation is interesting because it's at an all-time record high, notwithstanding all the talk about how you can't find truck drivers. And look at this, the wages are up 3.4% in trucking, but because the demand has been so strong for trucking services, we're seeing that the PPI for truck transportation is up a humongous 18.3% year over year. Here's what I said about medium weight and heavy truck sales. This may be a good indicator for an improvement in production of trucks, but that, as you can see, is actually an interesting indicator. It tends to actually start to turn over before recessions. This time around, and it did it even here, but it's not turning over here yet. It's going the other way, which is a happy sign. Warehouse and storage employment. All these truck drivers have to go somewhere. A lot of them are going into and out of warehouses. And as you can see, warehouse and storage employment, all-time record high. Let's look now at value of construction put in place. Looks great, right? led by residential construction. But let's not get too excited because as we know, the producer price index for final demand construction is up 15%. So you have to deflate that and you still get an uptrend, but nowhere near as exciting as what we see in the nominal data. This is one of the more exciting charts, I think, to the extent you want to get excited about my charts. This is non-defense capital goods orders and shipments, excluding aircraft, a good monthly indicator of capital spending on equipment. And as you can see, this has just gone off the charts. We have to keep changing the scale here to account for it. So that's a very good indication, I think, of, again, companies using capital equipment technologies to deal with the labor shortages and to onshore their supply chains. I mentioned imports. Let's skip to the lower panel here. This is real merchandise imports, all-time record high. So this, it's quite clear to me that it's been excessively stimulative fiscal and monetary policies that have stimulated demand, causing a demand shock, which then overwhelmed the supply system. And this chart, I think, is pretty reflective of that. These are the inbound container ships, and they correlate with the imports number, but adjusted for inflation, real imports all-time record high. So that's it on the charts. Why don't we go to the questions? Total debt in the U.S. is $85 trillion, usdebtclock.org. A 2% increase in interest rates is 1.7, oh, there she is again, is 1.7 trillion or 7% of GDP. The 2008-2009 GDP was minus 5%-ish. How can the Fed raise rates with the amount of debt we have? It is much easier to pay this debt back with cheaper dollars. I think that's a good plan. That's Scott made that point. It's something I think about. I think we all know that there's so much debt out there that interest rates don't have to rise very much to create a really significant increase in the amount of interest payments that companies, businesses, and the government has to make. So it's a good question, and whether we've kind of painted ourselves into a corner here in a situation where we have a wage price inflation spiral and we can't do very much about it because we can't raise interest rates without causing interest costs to go up dramatically and cause a recession. But look, maybe that's really it. I mean, the Fed officials and even Janet Yellen, who's now at the Treasury, has said, don't worry about inflation. We've got tools in our toolkits. And every time I hear that, it just makes me ill because it's like, what are they talking about? The only tool they have is to raise interest rates to levels that cause a recession. That's kind of it. And so we do have the potential here for a wage price inflationary spiral, where the only way to break the back of that would be Volcker 2.0. And hopefully we don't go there, but hope isn't a solution. And it is something we have to be concerned about. Let's see. I got all these distractions today. The phone's coming in. I thought I turned it off. Okay, Jay, how does Fed react during wars? Will they be hawkish or dovish from the past history? Good question. In World War II, they had to deal with the Treasury to keep interest rates close to zero and to basically fund all the debt that was issued by the Treasury during World War II. I think that's really the only relevant example. They came out of the Korean War, and actually there was an inflation that was caused by that. And they were dead set on getting rid of that Treasury Fed Accord, which had kept them from raising interest rates. So we don't really have much of experience. I mean, I don't think we can say much about, well, I guess Vietnam, Arthur Burns kept interest rates maybe too low in the face of rising inflation. Question is Jay Powell going to be like Volcker, or if there's a real inflation issue here, not that there isn't one now, but if it doesn't come down on its own, or will it be more like Burns or Miller? And we'll have to see, but I'm not so sure that we have a Paul Volcker running the Fed right now. How is institutional positioning amidst all these issues? Any charts on that? No, I'm sorry, I don't have that kind of data how institutions are positioned. Like everybody else, it's more kind of guessing than it is anything that we have hard data on or that we have hard data on. Tim, with the current geopolitical uncertainty, what are your thoughts on why North Korea has not used this as an opportunity? Give them time. I don't know. I'm not quite sure what you're talking about as an opportunity. I don't think the North Koreans are going to invade South Korea. I don't think they want to start a war with South Korea. I mean, it clearly is, there is a axis of evil out there, police states, authoritarian regimes, Russia and Iran and China and North Korea. Their governments are certainly not democratic and run by autocrats, and they can pretty much do things as they please, but they obviously have to factor in what the geopolitical reactions by democracies would be to hostile actions. But I think geopolitics, we found in the past, most of us, that it's been a good buying opportunity. But this geopolitical situation where the Cold War is making a comeback here, and it's not just Russia, it's also China. And as you said, North Korea is an issue. Maybe Iran kind of keeps quiet for a while because of some deal. But geopolitics, we can't ignore it. It's having an impact, and it could certainly impact economies through oil or the or supply chains. Let's see. Astrid, how do you play markets right now? Well, I think that you play where you think this plays out favorably for some sectors. It's clearly been a big plus for the energy sector. So we would remain overweight energy. Energy obviously is a good sector as a hedge against inflation. A good sector as a hedge against rising interest rates is financials. As long as you don't get a recession out of that, financials benefit from higher interest rates. And so that's a place to be. And given that all this commotion is certainly unsettling and unnerving, I'm still betting that things will play out well during the current decade, and that companies will spend a lot on technology to deal with chronic labor shortages, to hold on to their profit margins. And so I think anytime you get a favorite technology stock selling off, I would be a buyer there. So that's the way I would look at it. Bonds are, as we can, remained a little tricky here. Overnight, we saw the 10-year bond yield drop to 1.84%, I think it was. And then this morning, it was back up to 1.94%. The markets haven't quite figured out how to, I'm just looking at the markets because things change pretty quickly here. Haven't quite figured out how this all plays out for things. Clearly, I think there is an impact on inflation, which from higher oil prices. But then again, as I said, the Iranian deal may provide enough oil to offset that for a little while. Mark, what are your year-end forecasts for Fed funds, 10-year Treasury, and inflation? Fed funds rate 1%. I see 4 rate hikes. I know the 2 years factoring something like 7. 2.5% on the 10-year, closer to 2.5%. And inflation, I guess the optimist in me hopes that some of this inflation is supply chain related, and that inflation, and that as I've said before, a good part of this inflation has been consumer durable goods inflation, and consumer durable goods prior to the pandemic had a history of seeing their prices fall, not increase at double-digit rates as we've seen. So I think that'll help to moderate inflation, but I think we'll be lucky if we get it down to 3-4%. I don't think we're going to get it down to 2% ever again, or anytime soon, let's put it that way. And I will not be surprised if the Fed somewhere along the way raises the inflation target from 2% to 3% just to move the goalpost. Take a couple more questions. I think we're almost at our time here. Steve, today's note, truck tonnage still below pre-pandemic high, but truck employment at an all-time high, question mark. Yeah, I mean, it does suggest that productivity is not doing that well in the trucking industry. If they got record employment and yet the trucking index is kind of going sideways, though it near its previous record high before the pandemic, that does suggest that what are these truck drivers doing? The answer may be that because of the supply chain disruptions at the ports, at the rail yards, they may be taking more time to load and unload their cargoes. That's the explanation that I can come up with. And I'm going to squeeze one more in here. Eduardo, do you think China could invade Taiwan after this happens in Russia? Do you think Russia will calm down as they are not a country? Okay. Yeah, I gather from the question that yeah, I don't know what the Chinese are going to do, nor what the Russians are going to do. I think our botched exit from Afghanistan emboldened Putin, and so I think we're paying the price for that now. And much will depend on how significant the sanctions are against Putin. And Putin's he's still relatively young and still has ambitions to go down in history as the great uniter of the Soviet Union, the Russian Empire. And he's in no rush. He doesn't necessarily have to invade Ukraine tomorrow. There's some people saying that's about to happen. I mean, I just don't know. But so he may just play for time, stay with what he's got right now, and wait to see how things play out. The Chinese, I think, recognize how much is at stake if they were to invade Taiwan. So I think they're going to hold off on it. But I don't know what would keep them from infiltrating into the country and maybe destabilizing from that point of view. Both Russia and China, in other words, have the advantage of patience. They don't have to do anything abruptly. They can continue to sort of erode the resistance of the West to their, what else can you call it, but imperialistic ambitions. So with that, let me wish you a good week. Obviously, lots of commotion and tumult in the global economy. We'll do the best we can to keep you apprised of our thinking on all these developments. Oh, by the way, there's a, I should, let me see what we got here. Yeah, there's a 2 o'clock. I hope I'm not overwhelming you with webinars, but there's an inflation, predicting inflation webinar. It's a 1 hour webinar. I sent you a notice on it in the morning briefing. Have a look. It will be rebroadcast, and I'll let you know if you can't attend the 2 o'clock Eastern Standard Time webinar today. Thanks for following our research, for your interest in what we do, and I appreciate it very much. Again, all the best.